Welcome to the July 2021 investment update. I'm Justin Moilanen, and with me today is Vince Tortorici. We are both financial planners with Financial Service Group based here in Mount Pleasant, Wisconsin. Vince and I are both certified financial planners and investment advisor representatives. And today we're looking forward to going through some investment updates for you over the last several years. So let's dive right in. So to get started here, a quick overview of what we'll cover today. First, we'll look at the crash and recovery of the last 18 months. Then we'll transition to performance figures for U.S. stocks, international stocks, and bonds. What we're going to look at here is not specific mutual funds or exchange traded funds, but rather index performance to give you that overall view of how the market's done. Then we'll transition to portfolio performance, which will show you how mixtures of stocks and bonds have performed. I'll give you kind of that investor perspective on how 20% portfolio of stocks has done versus an 80% portfolio. Then we'll transition to timely topics. These are things on our mind, maybe on your mind as well. I'll give you our thoughts on those. And then lastly, we'll close with our process, which will give you an idea of how we go about creating, implementing, and then changing investment plans for our clients. Overall, our goal here today is to help educate. So the goal is to help you understand how portfolios are created, give you some things to consider. It's an alignment here with our values at FSG of continuous learning. So with that, let's dive in. So first actual slide here, the crash and the recovery. So this is, I'm going to ask you to kind of rewind the clock about a year and a half pre-COVID. What you're seeing in front of you here, it's going back to beginning of 2020. So this is kind of where you can see here, that's January 2020. On the vertical axis, you're seeing relative performance of stock markets relative to that date. So what Vince and I have drawn up for you here are, you can kind of see two different stock markets listed. The first is going to be the green line. That is the Russell 1000 index. That is large cap stocks. So think big companies. The blue line is the Russell 2000 index. So bear with me here, right? These are different indexes. Russell 1000 large cap, Russell 2000 small cap. Think again, large and small companies. Both though are United States companies, so companies domiciled in the US. What this slide is going to show you is really two things from my perspective. Number one is the crash and recovery. So if we take a peek at that, you can see really in March of last year, kind of tail end of February, COVID kind of breaks open and we saw a dramatic, quick decline in both markets, large and small cap. Both went down very fast. But then what happened really after the Federal Reserve stepped in and did a fair amount of money printing, if you've heard of that, a lot of stimulus bills, the markets started recovering. Right? Where not only did they recover to where they were before the pandemic, but now we've seen portfolio values up significantly above where we were at to start last year. We've been reviewing portfolios for the end of the second quarter here, and you can definitely tell that despite all the chaos of COVID, we had the presidential election in there, markets have been up. Bottom line figures for clients have been up really as a function of this activity in the market. So observation one was, again, the quick decline in markets, but also now the recovery and then subsequent growth from there have left portfolios well above where they were at 18 months ago. Observation two for you is, again, that kind of that disconnect between the two types of U.S. stocks. So generally speaking, both went down, both went up. But if you kind of dig in a little bit, you'll notice that U.S. small cap stocks went down much more than large cap. Draw out the recovery, you'll see that large cap stocks recovered by July, August or so of last year. Small cap stocks didn't recover until the end of the year, call it November. So small cap stocks down more dramatically, and their recovery took longer to get back to even. Interestingly though, what's happened since then is that small cap has actually outperformed large cap. So smaller companies have done better, where when you look at just this 18-month period, despite again that deeper decline, you're seeing small cap now at the end of second quarter, June 30th, 2021, they're slightly outperforming large cap. This here is a story of diversification, right? We own both large and small cap stocks. The key to recognize is that at any given time, you can have these different markets outperforming or underperforming. You want to own a bit of both. Now let's dive into some data for you, the actual numbers. So what we'll look at first is US stocks, then we'll look at international stocks, then we'll look at bonds. From a US stock perspective, just to set the stage for you here, we are talking about total return. What that means is a lot of times when you see the ticker on TV showing market performance, that's just the price performance. Total return is also including income dividend performance as well. So it's kind of from an investor perspective, it's showing you that bottom line number of what you should be returning. So we're looking at total return. The chart here has broad market, large, and small. So large and small are what I covered on the last slide, right? Broad market is basically a combination of both. On a time perspective, I've listed out a few different time periods. We've got year to date, so 6 months through June 30th. We've got 1 year going back to last summer, kind of mid-pandemic, if you will, and then 10-year figures as well. Now the 10-year figures, they're a bit maybe counterintuitive sometimes in that these are average annualized returns over that 10-year period. So in any given year, there's been negative performance, there's been positive performance, but if you average it out over the 10-year period, we have those figures listed. So if we break those out a little bit, we'll start at year to date. I mentioned before, right, small, slightly outperforming large at this point, but I think the moral of the story is across the board, markets are up big just in this 6-month period, right? Call it 15% plus. Rewind the clock, right? So we got a year look back, pretty comical numbers. Broad market up 44%, large up 43%, small up 62%. Why is that? Well, again, kind of percentages, how they work. Markets were down still at that point. So if you compare now to a declined market, that's going to be part of why the numbers are so aggressively large. They're over 40%, over 60% for small. Look back on a 10-year basis, and what are we talking about? Well, those average figures are, call it 15% for the broad market for large cap stocks. Small, lagging a little bit, 12%. But all three, honestly, historically, pretty darn high. You're talking about 12 to 15% per year for a decade. Large returns. For those of you that have portfolios with FSG, for those with portfolios outside of FSG, if you look at the bottom line numbers, you look back 10 years, stocks have done really well for you just as a function of the overall market. For Vince and I, one of the things that is important to kind of show you is the last decade, and then this final column I haven't described so far is the previous 10 years. What that means is from 2001 to 2011. So you're looking at kind of decade versus decade. Again, the last 10 years, we're up 15% per year, broad market. The previous 10 years, lost decade as it was sometimes known, only up about 3%, 4% per year. Small did a little bit better, but as you can see, significantly different. Right? So the question we always get is, okay, so what happens the next 10 years? Well, no one has a crystal ball. It's hard to say. But what we know is there can be a wide range of experience, not only quarter by quarter, year by year, but even decade by decade, you can have different performance. To the tune of, 10% per year difference is a significant return difference. We account for this with diversified portfolios, but I think from your perspective today, recognize that the last 10 years has been significantly above average. Doesn't mean that we'll revert back to those previous 10 years, but you have to at least take the last 10 years with a grain of salt. Previous slide, we discussed US stocks. Now we're going to look at international stocks. Again, total return through June 30th. With U.S. stocks, we looked at small versus large, kind of the size of the companies. For international, how we divide that up from a diversification perspective is developed countries versus emerging countries. Sometimes this isn't as intuitive as you'd think, but basically you can think of developed countries as kind of Western European, and then emerging countries like Brazil, Russia, India, China, so large countries, but all those would slot into emerging. From a performance perspective, pretty darn good numbers across the board. Everything's positive year to date, 1 year, 10 year, and the previous 10 years for that matter. If you actually look at the performance relative to US, it's lagging the last 10 years. So +9, +8%. It's lower than +15%, right? So it's underperforming US year to date. It's underperforming US on a 1 year basis, and even on a 10-year basis. International has underperformed US stocks. What I'll note here is you're still getting positive performance. Again, these are average figures on the 10-year. So 6%, 5% for emerging per year has been what it's done the last 10 years. Looking back, the previous 10 years, again, that's the 2001 to 2011 range. Developed markets, pretty comparable, right, to the last 10 years. But look at emerging markets. 16% in that time frame versus 5% the last 10 years. Again, all positive, but what this shows you, especially the emerging side, is you can have different performance in any different stretch of time, even these decade-long periods where this developed performance, that outperformed US stocks in this time frame, underperformed here. Emerging underperformed last 10 years, but significantly outperformed US before that. Another slide to illustrate that for you is what you're seeing here is the differential between US market returns and international, aka non-US returns. What you have is, here is your difference in total return on your vertical axis. The horizontal axis is time from 1972, this is through 2018. But the green line, if it's above this average line, US outperformed the previous year. If it's below, international stocks outperformed US the previous year. What's the takeaway? Well, I think it's that in any given year, international could outperform or underperform US. Now, it just so happens the last 10 years, international stocks have underperformed US. But looking forward, we need to account for the fact that they're going to ebb and flow. International, in addition to just the general countries, they also have currency fluctuations that are included in those market returns. That when we build a portfolio, we want a bit of both to make sure that we're diversified across the globe, the market cap, really in any country. And if you look at, you actually zoom out, you take all the companies in the world that are publicly traded, about 58% are in the US. But that means that 42% are outside of the US. So to have a US-only portfolio or an international-only portfolio, you'd really be selling yourself short, and I'd argue subjecting yourself to some risk that's unnecessary when managing your portfolio. All right, lastly, from a data perspective, so far we have talked really about stocks, right? US stocks, international stocks. Again, we subdivide those very simplistically into small cap and large cap. So that's the size of the companies. And then you have developed and emerging countries on the international side. Now we look at bonds. This is also known synonymous as fixed income. If you've heard of that, I would use them interchangeably. What we're going to show you here again is total return, so price and income performance through June 30th, 2021. And what we've listed out here, and this is a key distinction, is there's different ways to evaluate bonds. The way we look at it is the type of bond. So simplistically, think of it as corporate bonds, so issued by companies, or governmental bonds issued by governments, by countries. We focus largely on governmental bonds because they're typically the ones we use, at least, primarily the United States, are on the safer end of the spectrum compared to corporate. The other lens you can look at is the length of the bond. So you can buy a 1-year bond, you could buy a 30-year bond. The longer the term, the more interest rate risk of that bond. We tend to gravitate towards the shorter end of the spectrum. Why in both categories? Because we use bonds for income purposes, for stability. We like to keep it relatively safe. So we're not looking at things like junk bonds, high yield bonds. Those are categories, but they are not included on here because that is not how we approach the bond side of the portfolio. Data-wise, what you're looking at here, you can see year-to-date figures. Short, U.S. government, so that kind of 0 to 3 year United States government bonds, bills, notes. Year-to-date figures, down slightly, basically even. 1-year figures, same deal, right? Slightly positive, but right around the 0 mark. So not much growth there, but stable. Intermediate government bonds, so now we're looking maybe more in that 5 to 10 year range. That's where you're starting to see some declines in value. Vince is going to touch on this a little bit later, but part of the reason for that is when interest rates go up, prices go down. You're seeing that here in the bond portfolio, that intermediate government bonds, they're down 3% the last 6 months. The last category we have on here are intermediate U.S. TIPS. TIPS are Treasury inflation protected securities. These are basically investment products that help protect against unexpected inflation, and this is why you're going to see that difference. So the time frame, intermediate's similar, U.S. government's similar. Well, why negative 3% versus plus 1%? Well, it's because they're this particular type of government security. They're up 1.5, 1.4% year to date, 6% over the last year. On a 10-year basis, you can see the figures listed, all positive, clearly less than stocks on the whole, but from a portfolio management perspective, they are positive for clients. So with that, what we've gone through, again, just kind of set the stage for you: stocks, international stocks, bonds, short-term, long-term. I would draw a distinction here, largely in portfolio management. For us, we focus on stocks for long-term growth. So we're biased towards looking kind of towards those 10-year figures on the stock side. For bonds, we balance out portfolios with that. So we're more biased towards bonds for looking at shorter time periods for bonds because we might need that money in the short term. That's their objective in the portfolio. But how we mix them together, that's creating a portfolio. I'm going to toss it over to Vince to go through some of kind of the performance figures of various portfolios that we use for our clients.
Thanks, Justin. So what we're seeing here is performance data with portfolios that include both stocks and bonds. And a quick story, I had a client at Vanguard, where I worked prior to Financial Service Group, that called in one day and said, hey, the market's up 20%, but my portfolio is only up 12%. What gives? And the reason for that was because his portfolio wasn't composed solely of stocks. It was a balanced portfolio that contained both stocks and bonds. So it's important to note that performance is determined often by how much of your portfolio you have in stocks. And so this table shows during various time frames how a portfolio that contains both asset classes has performed. As you can see, when you move from a portfolio that contains 20% stock to 100% stock, the rate of return tends to go up. Well, that's indicative of a rising market. During a decreasing market, you would expect the opposite. A portfolio that has relatively low allocation in stock would fall at a lesser degree than a portfolio with 100% stock. So if we take a look at the 10-year performance across these different portfolios, over the last 10 years, a portfolio with 20% stock has risen about 3.6% annualized. So every year, that's the average it grew. Versus a 100% stock portfolio grew around 11%. So you might argue, well, why would I ever want less than 100% stock if the rate of return is more than double? Well, the reason for that is because all these portfolios have different levels of volatility. There might be years during that time frame, which I will illustrate in this next slide, where the market was down significantly, and you have to be able to withstand that amount of volatility. So here's another graph that illustrates what I'm referring to with regards to different levels of volatility with different amounts of stock in your portfolio. So this graph here shows the performance of various portfolios from 2007 to 2013. And so this the vertical part of the graph shows the rate of return versus the horizontal part of the graph shows the time frame. So if we look at a 20% stock portfolio, that's the lightest green line, you'll see that during this time frame there was pretty minimal movement, pretty minimal volatility in an otherwise very volatile time. I mean, think about this time frame. 2007, if you'll recall, was right after the housing market crash and subsequent market crash known as the Great Recession, where equities fell, stocks that is greater than 50%. So a 20% stock portfolio was pretty minimal in regards to its volatility because so much of that portfolio was invested in bonds, which have a relative safety as compared to stocks. Now take a look at the 100% stock portfolio, which is this darker blue line. Well, when the Great Recession occurred, you could see that that portfolio fell greater than 50% and had the sharpest decline as compared to the other portfolios. Subsequently, it took the longest for that portfolio to recover. So when we're constructing portfolios, which we'll discuss in a future slide, we have to be cognizant of the fact that some investors require a shorter time frame for their portfolio to recover from a market crash. And that might point us towards a portfolio that has a smaller amount of stock allocation. One, so they're not seeing humongous declines in their portfolio, but two, as referred to earlier, it would take a shorter amount of time for a portfolio with lesser stocks to recover. And then, just drawing those lines out further, you could see that the 100% stock portfolio declined the sharpest. It took the longest for it to recover, but if we expand the time frame to longer and longer amounts of years, you'll see that it actually performed the best over that 2007 to 2013 time frame. So that wraps up some of the performance data and the facts and figures. We now wanted to pivot in this investment update to review some of the topics that are occurring today, some of these timely topics. And the two we wanted to highlight are bond yields and inflation. So as Justin mentioned earlier, bond prices are affected by interest rates. Well, right now, we're seeing rising interest rates. That has a negative effect on bond prices. And to illustrate why, let's say you have a bond that is currently paying 3% interest, while other investors can go and purchase bonds today that are paying 6% interest. So the interest rates have risen. Well, the value of your bond is significantly less if it's paying 3% interest, but bonds that can be purchased today are paying 6% interest. And the opposite happens too. If interest rates fall, bond prices tend to go up. Another point with bond yields is that the longer the maturity on a bond, meaning the longer it takes for you to be repaid on that bond that you purchased, the more it is affected by interest rates.
Vince, if I can jump in real quick, we were talking earlier about how we use bond funds. We use funds for diversification. How does this relationship play out in the context of an individual bond versus a bond fund? Does it still hold?
Great question, Justin, and there is a key difference. So to explain, mutual funds can be a collection of stocks or bonds. And for our clients, we use bond mutual funds, meaning they are a basket that contains thousands of individual bonds within them. And to answer your question, well, in a rising interest rate environment, bond funds tend to behave a little differently than individual bonds. You have to imagine that these bond funds, they're continuously purchasing bonds throughout the year. So during a rising interest rate environment, the bonds that these funds purchase are paying higher and higher income on the higher and higher interest, meaning they're producing higher income. So while the bond prices within the fund might be declining, the income that the fund is producing is going up. And as a matter of fact, historically, we'll often see that bond funds can produce a positive return even in a rising interest rate environment. The next topic is inflation, which I'm sure you've all heard about or even experienced. So inflation, to define it, is the rise in cost of goods and services. A measure of inflation is a term called CPI, Consumer Price Index. And how we experience this is you go to the gas station, you go to the grocery store, you see housing prices as they go up. We're experiencing inflation. It's created by the fact that there's a higher and higher money supply chasing relatively the same or slightly increasing goods and services. So you have more people with more money vying for the same amount of products and services. You'll see prices tend to go up. And if we look back at the last 10 years, you can see on this table right here that the average inflation was close to 1.75%, versus back in the 70s and 80s when we had significant levels of inflation, the average was 6.3%. So what does this all mean today? Well, there's no crystal ball. We can't tell what inflation is going to be next year or in the years to come. But what we should know is that inflation is a changeable force, and it will certainly impact our financial health. So it's something that needs to be accounted for, especially when the government over the past 16 or 18 months has been printing money to help people pay for their grocery bills while they were potentially out of the job from the pandemic.
Yeah, that's an excellent point there, Vince. I know I've dealt with a lot of questions from clients of what's the ramifications of the last year? How will this kind of spill through to inflation? Do you want to touch a little bit on how, from a portfolio perspective, right? You touched on, we've got the recognition of previous inflation rates. What are some of the ways we go about kind of incorporating the possibility of future inflation into our portfolios?
Sure. Well, there's some investment products that are specifically designed to protect a portfolio from inflation. A couple examples: Treasury inflation protected securities, TIPS, one of the items in the bond performance that you identified. So those are bonds that have an inflation adjustment. So the interest that they produce goes up during rising inflation. Same scenario with Series I savings bonds. They have an inflation premium where you will get a higher level of interest when inflation goes up. So those are two types of securities that can be used to protect yourself from rising inflation. But I think the best protection would just be investing in stocks. So stocks, remember, they're ownership in companies. You purchase a stock, you own a share of a company. Well, during inflation environments, those companies are selling their goods and services at higher prices. They're able to generate higher revenues, and that causes either their stock price to go up or the dividends that they pay out to go up. So owning stocks is probably one of the best ways to protect yourself from inflation. It just also increases the risk in a portfolio. So it needs to be an appropriate level based on your individual circumstance. So when we meet with our clients, we discuss that and decide what would be the best measure of action. And Justin, I'll let you explain that a little bit more in regards to our process and how we work with our clients.
All right, thanks, Vince. Coming down the home stretch here, we've gone through some data, we've gone through some timely topics. Now we're going to talk a little bit about our process. And we are going to keep it general here today, right? When we work with new clients coming on board, this is a pretty involved process. Here today, I'd like to just articulate kind of the big bullet points of what should be considered when investing, right? Whether that's with us, we do that for our clients, or again, for non-clients out there, some of the things you should be considering that might not necessarily be on the evening news. So first and foremost, right, any plan starts with creating the plan. How we go about that is for any couple, for any individual, really at any age, we want to look at three different perspectives or three different lenses to ultimately arrive at how are we going to invest their pot of money. So those three perspectives, the first is risk tolerance. I assume probably most of you have heard that phrase out there. Really what it means is your comfort with volatility, kind of another investment buzzword, but the ups and downs with the market. You know, how are you going to feel if the portfolio, like March of last year of 2020, when it goes down 30% in a month, is that going to keep you up at night? That would be the kind of the classic risk tolerance question. Will it cause you to panic and sell what you have? That's evaluating number one, emotional comfort around your portfolio. The second is what's coined risk capacity. A little jargony, but what this is basically trying to illustrate is while you may be risk tolerant, you might be okay with the volatility of the portfolio. The question from our perspective is, well, can your portfolio actually sustain this volatility, right? So you might be okay with it, but let me give you an example. Let's say you're retired, you're drawing income out of the portfolio, meaning we're having to sell some of your assets to send you monthly income. At some point, even though you can tolerate the ups and downs, the portfolio itself may not be able to withstand 30, 40, 50% drop depending on the level of income we're sending out. So it's kind of a mixture of those two things, risk tolerance, risk capacity. The third perspective is what are you looking to accomplish? What's your objective, right? So again, whether you're 20, 30, 40 or 70, 80, 90, are you looking at growing the portfolio? Are you looking at income, meaning to draw money out of the portfolio? Are you looking to just preserve capital because you know you're going to spend it all down immediately? All of these are different objectives. They need to be considered among the risk tolerance and the risk capacity. And the key is with couples, right? You've got multiple risk capacities or multiple risk tolerances rather that you need to account for as well. You blend all that together, that's what you need to consider when you're creating a plan.
Justin, quick question on that. So you mentioned risk capacity, drawing income. Can you explain a little bit more, maybe give an example of how that might affect a portfolio's allocation?
Yeah, so this is a good one, and I think for those that are going into the retirement transition, it's definitely a change, meaning they went from an environment of saving, right, so putting money into the portfolio, to now taking money out. How do we account for that? Well, ultimately, because stocks can be so risky, we can't have everything in that stock bucket. So we want to put some in a more stable investment, that's bonds. Your question is, well, how much goes into the bonds? Really what we like to target is 6 to 10 years, kind of around the 8-year mark. We want outside of stocks. Now the actual dollar amount of what that means depends on how much money you're taking out, right? So if you're taking out $10,000 a year, or you're taking out $100,000 a year, multiply that out, and we're going to want that sort of safety net outside of stocks. Why is that? Because it's basically going to allow us to use that money, the bond money, while stocks are down if they're down. We already touched last year, right? They went down in a month, but they went right back up. What we're considering in the future is what happens if at any point in time stocks go down and they stay down for a year, 2 years, 5 years. The longer you can have outside of stocks, the longer runway that you have to be able to basically provide for your current income needs without having to sell stocks at a loss. After we've created the plan, there's the implementation. So I touched on this earlier. How do we go about that? We use diversified low-cost funds. So that's what's listed on your slide here. What does that mean, diversified? It means think owning thousands of positions, not tens of positions. So we want to get kind of broad exposure, again, owning thousands, countries, companies. We want all different sorts. What does that mean? It means sometimes you're going to have stocks that are at a loss, sometimes at a gain, but we pretty much can lock in market performance at that point. We do so again in a low-cost fashion, which Vince and I can both attest. We've had clients come in that mutual funds, exchange-traded funds, that's what we're talking about here, their expenses can vary wildly. We like to be on the low end of the spectrum where I've definitely seen the funds we use can be 10-20% of what some external funds will be. So that's kind of the investment vehicle implementation. On a review basis, and we have listed for you here is a few years ago we invested in some software that allows us we do ongoing monitoring of your portfolios, meaning really any given week we're keeping tabs in the market, we're seeing are we up, are we down, have you gone what we call out of range, meaning if you had a 60% stock target, are you now at 75%? Are you now at 40%? Do we need to go in and do something differently? If we do, that's called rebalancing. So it's listed on your slide here. Another thing that probably a lot of you have heard out on the webinar here today, heard of, but the rebalancing itself, what does that mean? It basically means taking you from where you're at and getting you back to your original target. So my example, it's taking you from the 75% you're at stocks, get it back to the 60% you were originally set at. So that's rebalancing. What it ultimately does is it implements a disciplined plan for the buys and sells. And it basically, if you look at it, you're buying when stocks are low and you're selling when they're relatively high. So it's implementing that approach with the idea of our goal for you, long-term performance.
Now, Justin, I've heard a number of thoughts with regards to rebalancing and what the optimal amount of rebalancing should be within a year, the timing. Could you talk a little bit about how often you need to rebalance and maybe what the risk is if you don't rebalance at all?
Yeah, kind of two separate questions there. I think both are good. There is, in fairness, a lot of research across the board on what the optimal frequency is. My take on it is to have an approach is probably the biggest factor, to not be going back and forth on what you think makes sense and kind of giving into the emotions of the investing. We've settled on, rather than a frequency basis, meaning quarterly rebalancing or annual rebalancing, we base it on how much the actual portfolio has gone up or down, so it's a percentage basis. And as far as your second question there, the risks to not rebalancing are the risk tolerance side of things. Of markets have gone up like they have the last year and a half. You could get to a point in the portfolio where the swings of it will become you'll be unable to handle them. So imagine going from 60% in stocks up to 90% in stocks, wild swings. You might find yourself getting into that kind of that panic range when you see a portfolio of stocks go up or down 60% on a much larger number. That's the risk on that side. On the flip side, rebalancing too much introduces different risks. The one that comes to mind immediately is the costs of the portfolio. I've heard it described as handling a bar of soap, right? The more you're transacting in there, rebalancing, let's call it daily, just to be comical here, there's going to be costs involved with that can erode your returns on that side. So again, big picture risks all over. I think our approach, the main thing for you to take away is it's a disciplined process for buying and selling. It's not based on short-term prognostication. It's long-term, ups and downs. We step in. It's not because of guesswork. It's basically comes down to math at some point. Lastly, on our end, updating the plan. We'll touch on this one briefly. I kind of touched on it there a few moments ago, but the reasons we make changes to the plan, it's not because of what we think is going to happen next week. It really is your individual circumstance. A classic example here is retirement. Someone who is transitioning from saving to spending, that's a big change, especially on the risk capacity side of things. And I think Vince and I would both attest, risk tolerance seems to change a bit as well in that frame. Things like that, that's what's going to impact us saying, yeah, you know what, you were comfortable with 80% in stocks, but now, new paradigm, maybe 65% is more appropriate. But again, it's dictated not based on what an advisor. There are some folks that think they can guess what's going to happen repeatedly over a 30-year time frame. That's not our approach. We want to take a long-term view, look at evidence-based investing, and make tweaks based on kind of where you're at and where you're going, rather than the market itself. So with that, that's going to conclude our presentation. I'm going to toss it to Vince to close us out today.
Thanks, Justin, and thanks everyone for joining us and listening in. I hope it was educational, informational. There's been a lot of noise, as there constantly is in this industry, of what you should do. And as far as our clients go, we're maintaining the discipline to the investment plans that we create and manage on an ongoing basis, and really just instructing on some of the things that might be expected. But if you have any questions or would like to talk with Justin or myself, here's the number for our office, and you've got those the emails right there as well. We'd love to hear from you, and thanks again.